Welcome to this screencast. We are looking at selling assets as an internal source of finance, and this is still in the context of growing the business. Quite often you would come across businesses that would sell their assets because they're just trying to survive. Recent-ish example was when the Ford Motor Company sold off the Volvo brand of cars in order to survive, and then they've done that very successfully. But this is, we're not trying to survive, the business is doing reasonably well, we're trying to raise some finance internally without having to use a bank loan. And maybe we've got something that we can sell. And when I say we can sell, is we need to find a buyer. This is not talking about selling an asset that is critical for you to keep on trading. So if you're a factory and you're selling the machines inside the factory, then that could mean the end of the business. That's not what we're trying to do here. Typically, this has happened recently when you're selling something that then you can contract. If you're selling your IT infrastructure, so that's all the computers and the employees who are making the IT technicians, and then you sell this to an IT specialist who would then be contracted to supply it as a service. So that it's not a key part of your business and you can keep on trading, but instead of having to buy new computers once in a while, and instead of employing people who are not the core knowledge of your business, but their job is just to keep those computers working, you now pay a fee to your contractor every month, and the contractor takes all the responsibilities of keeping the IT infrastructure going. Now, if you do manage to do something like that, then you've got an instant source, well, instant-ish, you got to negotiate the contract, but a source of cash. Now, once you have sold these assets, you get cash immediately in return. So instant source of cash, and then this source of finance, there is no interest, unlike a bank loan. So that's just money, you can spend it right now. You could argue in some cases, maybe this does not involve the shareholders, possibly. But most importantly, you're not diluting your share in the business. Now, there are some drawbacks. How do you replace what you've sold? So now you have got that cost of contracting the service. But in any case, in certain situations, when there is something you can sell and you've got a buyer, you'll find that this can be very beneficial to businesses, and then you don't have to go to a bank. So no bank being involved. Because banks are not necessarily a friend to the business. I hope you'll find this useful, and I look forward to reading how you put this into logical chains of reasoning in your work.